The next thing we have to look at in this topic is money and monetary policy, and in particular two things. First of all, the relationship between money and prices, and second of all, monetary policy. Now, these two separate elements of this next set of slides we're going through are related. However, we're going to treat them quite separately. We're going to deal with monetary policy first, so number two first, and then we're going to have a look at the relationship between the money supply and prices. So the easiest way to think about it at this point is monetary policy in Australia's case involves moving interest rates up and down to try to keep the inflation rate between 2 and 3%, whereas the relationship between money and prices involves looking at how changes in the supply of money affects prices. So the distinction between 1 and 2 will become clear as we move through the course. So first of all, dealing with monetary policy is conducted by central banks around the world. In Australia, the central bank is called the Reserve Bank of Australia. Now, most people know of monetary policy in terms of using interest rates to try to control the overall level of spending and control inflation. However, there are other ways of actually implementing monetary policy. So for example, in Singapore and Hong Kong, monetary policy involves controlling the exchange rate, not interest rates. And even in the past in Australia, we have controlled the growth rate in the money supply, not interest rates. And more recently, quantitative easing, which is a non-conventional form of monetary policy, has been used to try to stimulate economic activity in the US and Europe in particular. And QE is all about increasing the money supply. So I don't want you thinking that monetary policy is simply moving interest rates up and down. There are other policy tools, such as the money supply or such as the exchange rate, that can be used to operate monetary policy. Okay, now the first thing that we have to become familiar with in working our way through a description of how monetary policy operates in this country is the overnight cash market. So the overnight cash market is the one-day market for money. So you would have seen the sort of the term structure of interest rates previously. We're dealing with the one-day market for money here, and this is called the overnight cash market. So I've drawn a market here with 4 of the big Australian banks in that market. There are other financial institutions that participate in this market as well. To participate in this market, you have to get permission from the Reserve Bank of Australia, and you have to actually have something called an ESA, or an exchange settlement account, which is a bank account with the Reserve Bank to participate in this market. But you certainly got to go through quite a lengthy procedure prior to getting permission to operate in this market. So this is certainly not a market that you or I as individuals participate in. It's really big financial institutions participate in this this market, and they lend money to each other in this market. So let's just start off by trying to work out what the cash rate is. Now let's just assume that, taking a step back, the amount of money that is in this market at any given point in time is around about $750 million. Now that doesn't sound like a lot to a lot of people, but that's all that's required. Once you understand the role of this market, 750 million is plenty. And that 750 million basically sits in the exchange settlement accounts of the various financial institutions in this market. And these ESAs are bank accounts with the Reserve Bank. So total balances in the ESA is approximately $750 million. Now remember, I've just got 4 financial institutions in here. There are many more than that actually operating in the market. So what's the cash rate all about? Let's just imagine that there was one transaction on a particular day, and that transaction is you writing me a $1,000 check. Let's assume that you bank with the ANZ and I bank with Westpac. Now at the end of the day, ANZ is going to decrease the balance in your check account by 1,000, and Westpac is going to increase the balance in my savings account by 1,000. But the transaction doesn't end there, because there needs to be an electronic transfer of money from the ANZ to Westpac. So what will happen at the end of this day is ANZ will take $1,000 out of its exchange settlement account, its ESA, and transfer it to the ESA of Westpac. And once that money has actually transferred from the ANZ to Westpac, that transaction is then complete. And all of those sorts of transactions occur at the end of the day. In fact, what happens at the end of the day, if you can imagine, there'd be millions of individual transactions with money going in all sorts of different directions between these financial institutions. So the system actually works out the net transfer amount between banks at the end of each day and just makes one transfer to settle those obligations. So for example, if ANZ customers have written more cheques to Westpac customers than Westpac customers have to ANZ customers, there'd be one payment going from the ANZ to Westpac. If it was the other way around, where Westpac customers were writing ANZ customers cheques, there would be one payment going from Westpac to ANZ at the end of the day to settle all of those transactions. Let's just go back to our simple example where you wrote me a $1,000 cheque on a particular day, and that was the only transaction in the market. Let's also assume that at the end of the day, when ANZ wants to transfer the $1,000 to Westpac, the ANZ's got a bit of a problem. Let's assume that there is only $700 in the ANZ's ESA, so they're $300 short. In that case, because the Reserve Bank will not allow these banks to overdraw their exchange settlement accounts, their ESAs, the ANZ will have to go into this market and borrow money from another bank. So let's assume that the ANZ announces to the market that it needs to borrow 500. The NAB comes along and says to the ANZ, yep, we'll lend you 500. So that money then goes from the NAB's ESA into the ANZ's ESA. They had 700, they've borrowed 500 from NAB. ANZ now has 1,200. They can make that $1,000 transfer to Westpac, and all of their obligations are now complete. Now, the next day, maybe there is a net inflow of money into the ANZ's ESA account, and then the ANZ can repay the National Australia Bank the $500 and interest on that $500 loan for 24 hours. The interest rate that the National Australia Bank charges the ANZ is the cash rate. So, and that cash rate is the interest rate that the Reserve Bank changes when they want to change interest rates on mortgages and car loans and all sorts of other loans. A lot of people think that the Reserve Bank has some sort of power, direct power over mortgage interest rates and small business interest rates. It doesn't. It controls the market this way. What we're going to have to do a little bit later is work out how changing the cash rate actually affects other interest rates, such as mortgage interest rates. It's quite a lengthy chain of causality, but we'll work our way through that in the coming slides. So what we've got is the cash rate is the interest rate payable when banks lend money to each other in this very special market. And this market is not large, it's quite a small market, but that's the way it works. The Reserve Bank, they have a bank account as well so that they can trade money with these banks. So for example, prior to or just during the GFC, the Reserve Bank injected huge amounts of liquidity in this market. And they took the amount of money in this market from around 750 million to close to $8 billion. And that was the Reserve Bank actually injecting money into the ESAs of these banks. Now, the Reserve Bank certainly didn't just hand over that money to the banks. They actually purchased bonds off these banks and in exchange injected money into the ESAs of these banks. So it was actually a purchase of bonds. So that's one way that the Reserve Bank can actually inject more money or supply more money to these banks in emergency situations. They can buy bonds off them because these banks typically hold bonds as part of their investment portfolio. and the Reserve Bank can then inject money into this market and boost the balances of the ESAs of these banks. Now, these banks in emergency situations could then take some of these excess balances and use it to satisfy withdrawals from the savings accounts of their customers, for example. So it's one way the Reserve Bank can actually get money into the economy through the overnight cash market. Okay, one thing to note here, one question that I have been asked in the past is, what happens if no one wants to lend ANZ $500 on that particular day? Well, that never actually happens. If we have a look down here on the right-hand side, you'll see that the RBA pays the cash rate minus 0.25% on ESA balances. So if the cash rate is currently 5%, then any money these banks have sitting in their exchange settlement account earns 4.75%. So 25 basis points below the 5% cash rate. However, if the National Australia Bank lends the ANZ that $500, the National Australia Bank will actually earn 5%, the full 5%, the full cash rate on that money. So there's actually a financial incentive to lend other banks money because you will be earning an extra 25 basis points. Okay, the next thing is, what I've got here is the cash rate in Australia, and you can see the cash rate was reduced quite sharply in 2008-2009 following the global financial crisis. It was then increased in 2009-2010 when the Australian policymakers thought that we had dodged a bit of a bullet in terms of the GFC, but then it was quickly lowered again when they realised that the global economy was still in trouble, and the cash rate sits at 2% at the end of 2015 in this graph. But the important thing here is the movement in the 90-day bill yield. Now, 90-day bill yield, you need to understand what a bank bill is. A bank bill is a financial instrument that banks issue into the marketplace when they want to borrow money. So when banks want to borrow money from financial markets to finance their loan book or to undertake more lending, they issue bonds and bills typically. Now in Australia, we simply don't have enough savings going into the banking system to satisfy all of the lending that takes place. So on top of savings, banks need to raise money by issuing bills and bonds. So bank bills and bonds. And this 90-day bank bill yield is actually the interest rate that banks pay when they want to borrow money from financial markets for 90 days. So who would they borrow that money from? Anyone who wants to buy a bank bill. So it could be a hedge fund in Japan, it could be another government in somewhere in Asia, it could be a superannuation fund in America or Japan. It could be a local company, it could be anyone. That money can come in to the Australian bill market from many different places. The important thing is the correlation between these two interest rates. The central bank, the Reserve Bank, has control over this red cash rate line. They control it very, very well. So they set the target cash rate, and the actual cash rate at which financial institutions trade money with each other in the overnight cash market doesn't deviate from that, not even 1 basis point these days. So when the central bank controls the cash rate, it also moves the 90-day bill rates. And the 90-day bill rate is the interest rate that banks are paying on borrowing money for 90 days using a particular debt instrument called bank bills. It's the same with the 30-day bank bill interest rate and the 180-day bank bill interest rate, which we'll see a little bit later. Those interest rates move incredibly closely with the cash rate. So the next question is, well, why do they move so closely with the cash rate? Why does the 90-day interest rate move so closely with the cash rate? And in fact, also the 30-day bank bill rate moves even closer with the cash rate than the 90-day rate does. The reason these two interest rates are so closely correlated is that the overnight cash market and the 90-day bill market have a degree of substitutability between them. So, for example, if a company has $1 million excess funds, that company, through its financial institution, and let's just imagine the company has $1 million excess funds that they don't need for 90 days. After 90 days, they want the money back to pay for maybe the next phase of an investment project. But they don't need this $1 million for 90 days. Through their financial institution, this company has two options. They could invest it in the cash market, or their bank could invest it in the cash market on their behalf and earn the cash rate, or they could just, through their financial institution, invest that money in the 90-day bill market. Now, if they invested that money in the cash market, they would have to roll that money over each day, and that money would have to be reinvested and loaned out to a new financial institution almost every day. Sometimes transactions in the cash market last for 2 or 3 days, but it's rare. So if you've got $1 million and you want to invest that money through your financial institution, you could actually go into the cash rate market and just keep rolling the transaction over each day. That means lending the money out to a new person each day, or a new financial institution each day, or you could go into the bill market and just lend it out once for a period of 90 days. So because you've got that substitutability between these two markets, that's why interest rates in these markets don't get too far out of line. So the central bank, when they change the cash rate, they're actually changing the interest rate that banks pay on their borrowing. And in turn, the banks then pass these interest rate changes on to their customers by changing mortgage interest rates. So what we've got over here on the bottom right-hand side are the policy interest rates for the US, the Euro area, and Japan. And what you can see is that these policy interest rates, they really did come down in 2008, 2009 as the GFC hit. But there's not a high degree of correlation between these policy interest rates, because they really are, the level of these interest rates are at the discretion of the central banks of each of these countries. So for example, unlike 10-year interest rates, which we saw in topic 1 do move together over time across countries, these short-term interest rates, because they are not subject to the same global forces as 10-year interest rates, they're under the control of the central bank. They can move independently. So when interest rates in the US were going up, they remained flat in Japan. That doesn't really happen with 10-year interest rates. When they were coming down in the United States, they were flat in the Euro area around about 2007, 2008. So once again, we've got these short-term interest rates, and what you're looking at there with the policy interest rates are the one-day interest rate, so the equivalent of the cash rate in Australia. So these things do move independently, quite independently. Okay, so the next thing, looking at the funding composition of banks in Australia, what we're trying to do is gain an understanding of how a change in this cash rate flows through financial markets and forces banks to change their mortgage interest rates. So what we've got here is an increasing cash rate through 2004, 2005, 2006 and 2007 as well. Now as that cash rate increased on the left-hand side of this diagram, it actually increased the 90-day bill interest rate as well. Now the bill interest rate, that is short-term debt. Because it's only a 90-day period, is what we call short-term debt. So if we have a look at this other graph over here, this has come from an RBA publication. I've given you the link at the bottom of the slide here. That 90-day interest rate is a type of short-term debt. Now, if we have a look at this short-term debt only accounts for, in 2014, around about 22 to 24% of bank funding. So what's happening here is the central bank, the Reserve Bank, is changing the cash rate. That is then changing the interest rate on short-term debt, on 90-day bank bills, for example. So 30-day, 90-day, 180-day, 270-day bank bills, it's all short-term debt. Anything less than about a year we call short-term debt. So the cash rate changes interest rates on all of this short-term debt. Problem is, short-term debt only accounts for 22 to 24% of bank funding. Banks also borrow money to lend to their customers using domestic deposits, that is, deposits from their customers. They also use long-term debt, and there's a little bit of equity and securitization in there as well. But we'll just focus on the big three: short-term debt, long-term debt, and domestic deposits. The problem for monetary policy these days is when the cash rate is changed, it changes the interest rate in this graph on the left on short-term debt only. And short-term debt is only 22 to 24% of bank funding. When the cash rate changes, it doesn't significantly change the interest rate on this long-term debt, and it doesn't change the interest rate on domestic deposits. The interest rates on long-term debt are driven more by global forces. We saw that in the first topic. And interest rates on domestic deposits, well, they move reasonably closely with the cash rate, but certainly not as close as the interest rate on the short-term debt. So the problem is this. In recent years, we have been in situations where the Central Bank of Australia, the Reserve Bank, has been cutting the cash rate to try to lower mortgage interest rates, for example. However, at the same time as they were reducing the interest rates on short-term debt, the interest rates on long-term debt were rising, and the interest rates on domestic deposits that they had to pay to attract enough domestic deposits, those interest rates were rising as well. So the central bank was trying to push interest rates down by reducing the cash rate. That was reducing interest rates on short-term debt, but interest rates on long-term debt and domestic deposits were partially cancelling out the interest rate reductions on short-term debt. And so it meant that the banks weren't able to pass on all of the Reserve Bank's interest rate cuts. Now, the way the market works, the central bank doesn't have control over interest rates on domestic deposits, and they certainly don't have control over interest rates on long-term debt. So, and there was quite a lot of uproar actually, and quite a lot of public backlash when this happened a few years ago, when the Reserve Bank was cutting the cash rate, but the banks weren't able to pass on all of the interest rate cuts because the interest rates on these other sources of funding were actually going up. The banks were sort of stuck. Now, I do remember the CEO of Westpac at the time coming out and trying to explain to the Australian people why they couldn't cut interest rates in line with the Reserve Bank's, or why Westpac couldn't cut mortgage interest rates and other interest rates in line with the Reserve Bank's cash rate. But at the time, the public didn't really understand, the public didn't want to know, and certainly the media was part of this bank bashing frenzy at the time. Okay, so that should give you a feel for how changes in the cash rate affect the cost of bank funding. These days, what's more important is the weighted average cost of bank funding. So if you read the article, the PDF file at the bottom of the screen here, that I've provided the link to, it'll give you a better idea of the factors that, or where banks borrow money from and the factors that do drive these interest rates. But the key thing to note is that we've got 5 sources of bank funding, 5 ways that banks can actually get money to lend to their customers. And the interest rates that the banks have to pay on each of these sources are driven by different factors. They can actually move in different directions at any point in time. And so what's more important today is a weighted average, the weighted average interest rate of these 5 sources of funding. Now, obviously, when the cash rate changes, it falls, for example. The interest rate on short-term debt falls as well. If interest rates on long-term debt and domestic deposits are able to move down at the same time, then banks can pass on that full interest rate cut to their customers. However, if those other interest rates are not falling at the same time, it makes it very difficult for banks to pass on full interest rate cuts. Now, what I've got here is the monetary policy transmission mechanism. This is something you'll learn more about in a couple of topics from now, but basically what we've got is a change in the official interest rate and how that flows through and affects inflation. Now, rather than explaining it now, because we haven't developed the necessary background knowledge quite yet to fully understand this, I'm going to leave this and encourage you to look back once you've done the monetary policy topic in this course. Look back and this diagram should make a lot more sense. Okay, the next thing we need to do is look at the relationship between money and prices. With this particular slide, I've got an equation here which is known as the equation of exchange. So M times V equals P times Y. The variables are defined down here, and so I've got a numerical example to help explain what's going on in this diagram. Let's assume that we're in an economy and that economy produces 250 Mars bars, and the price of a Mars bar is $2. So the total output in 1 year in this economy is $500 worth of Mars bars. Nothing else is produced apart from Mars bars. Let's also assume that the money supply is equal to $100. Now, the velocity is really the only variable that you should be unfamiliar with. The velocity of this money is equal to 5. It's whatever number makes this equation hold. So the velocity of money is defined as the number of times that the money supply needs to be spent to purchase what is produced. So we have to actually purchase $500 worth of Mars bars, we need to use the money supply 5 times on average. So every $10 note will be used 5 times on average. That's the velocity of money. Now, what we are actually heading towards using this equation is a better understanding of hyperinflation. So what you can see here is Zimbabwean currency, and we've got a $10 note down here, but after the hyperinflation we had a $100 billion note. So how does that actually work? Well, during a hyperinflation, generally what happens is central banks on behalf of the government start to print money. And they print money to start spending this money. Now, typically it will happen in countries that are going through fiscal problems or who have corrupt governments. So the government, rather than borrowing money or taxing citizens, very often they don't have those options available to them because they're very politically a very risky regime, and international lenders won't lend that regime money, or the government doesn't want to cause too many problems domestically and tax consumers too much, tax households too much. And certainly in many cases the government actually wants more money to spend than it can actually raise through tax revenue. So it can't borrow money, it can't tax the citizens and companies and obtain enough money to spend the amount that they want to spend, so they start printing it. Now, looking at this equation, as the money supply increases, what's going to actually happen is, let's assume that velocity is constant for simplicity at the moment. So V is constant. As the money supply begins to double and then triple every month, and that can happen, then with velocity constant, the only thing that can happen is either the price level goes up or output goes up. Now think of it this way, if you double the money supply, is it possible that the amount of Mars bars that you can produce in this mythical economy, can that double? Well, the chances are not, because assuming that you were close to capacity previously and didn't have too much extra labour and capital, the amount that you can actually produce, 250 units, is restricted by the amount of capital and labour you have. And simply by printing more money, that doesn't mean you can actually produce more output. So what's going to happen is rapid growth in the money supply is going to flow through, because it can't be satisfied or because it can't cause increases in physical output, which is the 250 units of output, which we've defined as real GDP here. It's got to show up through the price level, but it gets worse than that. So as the money supply is growing, the price level begins to grow in percentage terms. But as the money supply grows and pushes the inflation rate, or the percentage growth rate, and the price level up, people begin to realise that the money they're holding in their purses or wallets is quickly becoming worth less and less every day or every hour. So people then start to spend money faster, which then increases the velocity of money. So not only in these hyperinflation countries have we got the money supply growing, we've got the velocity of money growing as well. So the whole money supply is not turning over every month or every week, it's now turning over every hour. And so with big increases in the money supply and velocity, you can just imagine the type of inflation that you can get as a result of that. So obviously with the money supply increasing and these corrupt governments that do this type of thing tend to print one amount of money, then they've got to stay ahead of the inflation. So there's no point in printing the same amount of money next time your bank balance falls to zero as a government. You've got to print more to try to stay ahead of the inflation. So as you try to print more and more each round of printing, that just drives the inflation rate through the roof. So what we've got here is Zimbabwe's hyperinflation, and you can see that the annual inflation rate started off at a fairly mild 2,200%. That's a year-on-year inflation figure back in 2007, but at the height of the hyperinflation in November 2008, the inflation rate had hit some incredibly large number. So it's hard to even work out how large that number is. It looks like 90 billion or something ridiculous. I'd have to have a closer look at it to work out what inflation rate that number is, but it is caused by excessive printing of money. The velocity of money goes up and things get completely out of control. Now, in terms of the relationship between money and prices, I've got a time series here, a 45-year time series of the growth rate in the money supply and the growth rate in inflation in the United States. So this line here, that's the inflation rate in in the United States. Similar to us, they had very high inflation following the early 1990s oil price shock, another bout of inflation following the 1980s oil price shock. So that's inflation, and what I've done here is put a moving average through the series. So I'm not interested in the year-to-year volatility of the inflation rate. In fact, that's quarterly data, so I want to smooth it out to get rid of that short-term volatility. And on top of the inflation rate, I'm imposing the growth rate and the money supply. Now, if you have a look at the two series, quarter by quarter, there doesn't seem to be too much of a correlation. But if you take a moving average of the money supply series, the correlation is incredible. So what that is showing is that inflation really is a monetary phenomenon, and the easiest way to have an outbreak of inflation is to allow the money supply to grow too quickly. Now, one of the ways that I've motivated that the money supply can actually grow too quickly is simply by printing money, but later on we will see that the banking system can actually create money by the credit creation process. So we need to be able to come back to this slide once we've learned how the credit creation process works later on in this topic, and have that as a second way that banks can actually increase the money supply. Quantitative easing is the third. So on this slide, for when you get closer to the end of the course, it would be good to make a note on this slide. The money supply can grow three ways. You can actually print cash. The banking system can create money through the credit creation process, and the final one is the central bank can actually create money through quantitative easing. Doesn't matter which is used, if the growth rate in the money supply is too rapid, it will create price inflation.